You see, most men come to the market believing profits are waiting for them like apples on a low branch. They imagine that if they study a few charts, memorize a few patterns, perhaps follow the right tip, the market will reward them quickly. I have watched this belief ruin more traders than a panic ever could. The truth is simpler and far more brutal. Before a trader ever becomes consistently profitable, he must pass through certain stages. These stages are not pleasant, they are not glamorous, and they cannot be skipped. Have you ever wondered why so many traders disappear after a year or two? It isn't because the market is impossible. It's because most men refuse to endure the lessons the market demands. The first stage is confusion. Now, when a man first arrives in the market, everything appears logical to him. Charts look clean. Trends seem obvious. Every breakout appears like an opportunity. He tells himself, if price moves above this level, I'll buy. If it falls below that level, I'll sell. Simple, isn't it? But the market has a way of humbling simple ideas. You enter a trade because the chart looks strong. The price rises a little, then suddenly reverses and hits your stop. You wait for another setup. This time you sell a breakdown. It falls for a moment, then turns around and climbs straight against you. Sound familiar? At this stage, the trader believes the market is random. He begins to chase indicators. He adds oscillators, moving averages, colored signals. Anything that promises certainty. But certainty is not something the market sells. What the trader doesn't yet understand is that charts are not puzzles to be solved once. They are stories of crowd behavior unfolding over time. And crowds rarely move in straight lines. The man who survives this stage begins to realize something important. The problem isn't the market. The problem is his expectations. You see, the beginner believes he must predict every move. The experienced trader knows he only needs to recognize the important ones. A subtle difference, but a powerful one. Now comes the second brutal stage. Loss, and I don't mean a few small losses. I mean the kind of losses that make a man question whether he belongs in the market at all. Every trader pays tuition. Some pay it slowly, others pay it in large installments. But everyone pays. Tell me something. When a trade moves against you, what do you feel first? Is it discipline? Or is it hope? Hope is expensive in speculation. The amateur holds his losing trades because he hopes they will come back. He tells himself the market is wrong. He searches for reasons why price should reverse. But the market cares very little about what a trader believes should happen. A chart only records what is happening. Livermore learned early that the big losses do not come from being wrong. Being wrong is natural. No trader can avoid that. The big losses come from staying wrong. At this stage, a trader begins to see a pattern in his own behavior. His winning trades are small, his losing trades are large. Have you ever noticed how easy it is to take profits quickly, yet how difficult it is to close a loss? That is not a strategy problem. That is a human problem. The market exposes human weaknesses more efficiently than any teacher ever could. Fear, greed, impatience. They appear on your chart not as indicators, but as mistakes, and those mistakes leave footprints in your account balance. Now here is where many traders quit. They decide the market is rigged, manipulated, or impossible. They walk away and say speculation is gambling. But the few who remain begin to notice something. Their losses start to teach them. They see that the market rewards patience more than activity. They see that the best trades often require waiting, sometimes waiting longer than feels comfortable. And slowly, the trader begins to understand the third stage. Discipline. Not the kind of discipline people talk about casually. I mean the kind that reshapes the way a man thinks about money. You see, most beginners focus on finding winning trades, but the seasoned trader focuses on protecting capital. Why? Because without capital, there is no next opportunity. Have you ever sat in front of a chart and felt the urge to trade simply because the market was open? Of course you have. Every trader has. But the professional understands something the beginner does not. The market does not pay for activity. It pays for patience. Livermore used to say that the big money was never made in the buying or the selling. It was made in the waiting. Now think about that for a moment. Waiting requires confidence. Waiting requires restraint. Waiting requires ignoring the noise that surrounds the market every day, and that is difficult for most men. At this stage, the trader begins to read charts differently. He stops reacting to every candle. He begins watching the broader movement of price, the trend, the structure, the behavior of volume. He asks himself questions. Is the market trending or merely wandering? Are institutions accumulating or distributing? Is this move strong or merely emotional? These are not questions a beginner asks. They are questions that come from experience, often expensive experience. And something else begins to change. The trader stops thinking about trades individually. Instead, he begins thinking in series of trades. One trade means very little. 10 trades begin to show patterns. 50 trades reveal the truth about a strategy. This shift is critical, because when a trader stops judging himself by one outcome, he becomes less emotional. And when emotion fades, clarity begins to appear. Now don't misunderstand me. Discipline does not eliminate losses. Losses remain part of speculation. The difference is that disciplined traders keep those losses small. Very small. Small enough that one good trend can outweigh many mistakes. Have you noticed how the biggest market moves often occur after long periods of quiet? That is not an accident. Markets breathe. They expand and contract. The patient trader waits for those expansions, the moments when price begins to move with conviction. And when that moment comes, he does something the beginner rarely does. He lets the trade work. Most amateurs close winning trades far too early because they fear giving back profit. But the experienced trader understands that trends, real trends, can run far longer than people expect. The trick is not predicting them. The trick is recognizing them early and having the courage to stay with them. But here is the part few people mention. Even after learning these lessons, the trader still faces doubt, because markets change. What worked last year may not work this year. What worked yesterday may fail tomorrow. So the trader must continue observing, adapting, refining. In other words, the learning never ends. And that realization brings us to a quiet truth about speculation. Profitability is not a single moment when everything suddenly becomes easy. It is a gradual transformation. A transformation in how you read charts. A transformation in how you think about risk. A transformation in how you manage your own emotions. Most men want the profits without the transformation, but the market demands both. And that is why these 3 stages, confusion, loss, and discipline, are so brutal. Because they change the trader before they ever change his account balance. And if you're listening to this and wondering where you stand, ask yourself one question. When you look at a chart, are you trying to force a trade, or are you learning to wait for the market to reveal its hand? Most traders enter the market carrying expectations that were never shaped by the market itself. They arrive believing that profit should appear quickly if they study hard enough, watch enough charts, or follow the right strategy. It sounds reasonable at first. After all, the charts seem clear, the patterns look obvious, and the opportunities appear everywhere. But the market has a peculiar way of exposing expectations that do not belong there. Have you ever opened a chart and thought the direction was obvious? The trend looks clean, the breakout seems strong, and the trade feels almost certain. So you enter with confidence, maybe even a little excitement. Then suddenly the price stalls, hesitates, and turns the other way. And you begin to wonder what went wrong. At that moment, most traders believe the market betrayed them. They blame manipulation, bad luck, or unexpected news. But often the real problem sits quietly in the trader's own expectations. You see, the beginner expects the market to behave logically. He believes that if a setup looks good, it should work quickly. If the analysis is correct, price should move in his favor almost immediately. But the market is not obligated to reward analysis on schedule. Price moves according to the behavior of thousands, sometimes millions, of participants. Institutions, funds, hedgers, speculators, algorithms, all reacting to information at different speeds. That crowd rarely moves in a smooth and orderly way. So when a trader expects precision, the market responds with uncertainty. And that uncertainty is uncomfortable. Think about it for a moment. When a trade doesn't move right away, what does the average trader do? He begins to question the setup. Maybe he closes the trade early. Maybe he flips direction and enters the opposite side, or perhaps he adds indicators hoping to find a clearer signal. But the market hasn't changed, only his expectations have been challenged. Most beginners also expect trading to be active. They believe that profit comes from constant participation. The market is open, the chart is moving, so surely there must be something to trade. Yet the experienced trader knows that many days offer no real opportunity at all. The market spends long stretches doing very little of importance. Prices drift sideways, trends pause, momentum disappears. These periods exist to wear down impatient traders, and they do so very effectively. Because when expectations demand action, patience becomes nearly impossible. Another expectation many traders carry is the belief that a good strategy should avoid losses. They search endlessly for systems that promise high win rates, perfect entries, or consistent accuracy. But speculation has never worked that way. Losses are not signs that a trader is failing. They are simply part of the cost of participating in uncertain outcomes. Every professional trader understands this, even if beginners struggle to accept it. The difference lies in how those losses are handled. When expectations are unrealistic, losses feel like proof that something is wrong. The trader begins adjusting strategies constantly, abandoning plans after only a few trades, searching again for the better method. But the market does not reward constant switching. Consistency in thinking matters far more than perfection in prediction. This is where many traders slowly begin to change their perspective. After enough experience, they start realizing that the goal of trading is not to be right all the time. The goal is to manage risk so that mistakes remain small while opportunities are allowed room to grow. That shift alone removes a great deal of pressure. Instead of demanding that every trade succeed, the trader begins asking a different question: is the risk reasonable compared to the potential reward? And when that question becomes the focus, expectations begin to align more closely with the reality of the market. Now the trader no longer expects every breakout to run immediately, every trend to continue smoothly, or every analysis to prove correct. Instead, he understands that uncertainty is the natural environment of speculation. And once a trader truly accepts that uncertainty, he stops forcing the market to behave according to his expectations. Many beginners stare at charts as if they are looking at a crystal ball. They believe the patterns on the screen exist to predict the future with precision. A triangle forms, a breakout appears, a support level holds, and the trader thinks the next move must already be decided. But charts were never meant to tell the future. They tell a story. A price chart is simply a record of decisions made by thousands of traders and investors. Every candle represents a battle between buyers and sellers. Every breakout reflects a moment when one side temporarily gained control. Every pullback reveals hesitation in the crowd. When you look at a chart this way, something changes in how you interpret price movement. Let me ask you something. When price suddenly accelerates upward, what does that really mean? Is it just a line moving higher? Or is it a signal that buyers are becoming aggressive while sellers are stepping aside? The chart is not predicting anything. It is revealing behavior. The beginner often focuses on patterns alone. He memorizes formations, double tops, flags, channels, breakouts, believing that these shapes automatically lead to certain outcomes. And sometimes they do. But the pattern itself is not the real information. The behavior behind the pattern is: take a simple breakout. On the surface, it looks like price merely moving above resistance. But if you look deeper, that breakout tells you something about the crowd. It suggests that the sellers who once defended that level have either been absorbed or overwhelmed. Now consider another breakout that fails quickly. The price moves above resistance for a moment, then collapses back down. What does that reveal? It tells you that buyers were not strong enough to maintain control. Perhaps the move was driven by excitement rather than conviction. Perhaps larger players used the breakout to sell into strength. Again, the chart is not predicting the future. It is exposing the actions of participants in real time. Have you ever noticed how certain price levels seem to matter again and again? Support becomes resistance, resistance becomes support, and price often reacts near the same zones repeatedly. This is not magic, it is memory. Traders remember where they bought and sold. Institutions remember where they accumulated positions. Those memories influence future decisions. When price returns to those areas, the crowd reacts. The chart simply records those reactions. Now here is where many traders misunderstand chart reading. They believe that more indicators will reveal more truth. So they fill their screens with oscillators, moving averages, signals, and colors. But too much information often hides the most important information: price itself. The tape, as traders used to call it, already contains everything necessary to understand the crowd's behavior. Speed of movement, size of candles, strength of trends, sudden reversals. These clues reveal shifts in supply and demand. If a stock climbs slowly with hesitation, the buying pressure may be weak. If it rises sharply with strong momentum, the demand may be far greater. If volume expands while price holds steady, accumulation may be taking place. These observations come not from prediction, but from interpretation. Think of it like watching a crowd gather outside a theater. If people begin arriving steadily, you can see interest building. If a sudden rush appears, excitement is spreading quickly. If the crowd suddenly disperses, something has changed. The chart is simply that crowd viewed through numbers. This is why experienced traders often spend years studying price movement. They are not memorizing patterns, they are learning to recognize behavior. Over time, they begin to notice subtle differences between strong trends and weak ones, between genuine breakouts and emotional spikes, and those differences matter greatly. Because when you stop expecting charts to predict the future, you begin using them for what they truly offer: insight into how the market participants are behaving right now. You begin asking better questions. Are buyers gaining strength or losing it? Is this move supported by participation, or is it fading? Are institutions quietly accumulating positions or distributing them? The chart will not give you a guarantee, but it will always show you the footprints left behind by the crowd. A trader often believes the market is his greatest opponent. He blames sudden reversals, unexpected news, or large institutions moving prices against him. It feels as though the market is constantly working against his trades, almost personally. But the market is not concerned with any individual trader. The truth is far less dramatic. A trader's greatest enemy usually sits quietly behind the screen, making decisions under pressure, reacting emotionally to every tick of price. That enemy is the trader himself. Have you ever noticed how a losing trade feels different from a winning one? When a trade moves in your favor, you feel relief, sometimes even excitement. Closing the position feels easy. But when a trade moves against you, something changes. The mind begins to negotiate. The trader tells himself the move is temporary. Maybe the market will turn around. Maybe the analysis was still correct. And so he waits. At first, the loss is small. It feels manageable. Closing the trade would only require admitting the mistake. Yet many traders hesitate at this exact moment, because admitting a mistake is uncomfortable. Instead of accepting the loss, the trader begins searching for reasons to stay in the trade. He zooms out on the chart to find a new support level. He checks other indicators, hoping one of them confirms his belief. He reads opinions online that agree with his position. In other words, he stops observing the market and begins defending his opinion. That shift is dangerous. The market does not punish traders for being wrong. Being wrong is part of speculation. Even the most experienced traders make incorrect judgments regularly. What destroys traders is not the mistake itself, but their refusal to accept it quickly. A small loss is easy to recover from. A large loss requires time, effort, and often emotional damage to the trader's confidence. Let me ask you something. When a loss begins to grow, what happens to the trader's thinking? Clarity disappears. Instead of calmly evaluating the chart, the trader begins reacting to the loss itself. Every tick against him feels heavier. Every small bounce feels like hope returning. The trade becomes emotional rather than analytical, and once emotions take control, discipline fades. Some traders respond by averaging down, adding more to a losing position in hopes of reducing the average price. Others remove their stop loss entirely, convincing themselves that the market will eventually come back. But the market has no obligation to rescue anyone. Many great market collapses began with traders holding positions that should have recovered. The experienced trader learns a painful lesson here. The market rewards flexibility far more than stubbornness. A trader must be willing to change his mind quickly when the evidence changes. If price moves in a way that contradicts the original idea, the position must be closed. Not because the trader lacks confidence, but because capital must be protected. Capital is the trader's lifeblood. Without it, there is no opportunity to participate in future trades. Think about that for a moment. A trader who cuts a loss early remains free to act again tomorrow. A trader who allows losses to grow may spend weeks or months simply trying to recover. That is why professionals often appear almost indifferent when closing losing trades. They understand that a loss is merely information. It tells them that the market did not behave as expected. Nothing more. In fact, some of the best traders close losing trades faster than beginners ever would. Not because they fear the market, but because they respect uncertainty. They know that protecting capital gives them the ability to survive long enough to catch the moves that truly matter. Have you ever noticed how one strong trend can erase several small losses? That is the mathematics of speculation. But those trends can only be captured by traders who remain financially and emotionally stable. A trader buried under large losses rarely has the clarity needed to recognize new opportunities. And this is where the real enemy reveals itself. It is not volatility. It is not manipulation. It is the quiet voice inside the trader that says, "Just hold a little longer, it will come back." Most beginners enter the market with one goal in mind, finding the perfect trade. They study entry signals, search for precise patterns, and spend hours trying to identify the moment where price will move exactly as they expect. To them, the entry point feels like the most important part of trading. After all, if you enter at the right time, the profit should follow. But the market rarely rewards that way of thinking. Have you ever watched two traders take the same setup at nearly the same price, yet end with completely different results? One trader makes money, the other loses. The chart was the same. The entry was nearly identical, yet the outcome was very different. Why? Because entry alone does not determine success in speculation. The beginner spends most of his energy trying to avoid being wrong. He believes that if he can improve his entry accuracy, the losses will disappear. So he keeps refining indicators, adjusting signals, and searching for a method that produces more winning trades. But in doing so, he overlooks something far more important: risk. The professional trader understands that uncertainty cannot be eliminated from the market. No strategy, no pattern, no analysis can guarantee that the next move will behave exactly as expected. And because of that uncertainty, protecting capital becomes the foundation of every decision. Let me ask you something. Before entering a trade, what do you think about first? Do you imagine how much profit the trade could bring? Or do you consider how much you could lose if the idea turns out to be wrong? Most beginners think about the reward first. They picture the price reaching their target, the trend continuing, the trade working exactly as planned. Loss feels like a distant possibility rather than an immediate concern. The professional trader reverses that thinking. Before entering any trade, he measures the risk. He studies the chart and determines where the idea would clearly be invalidated. That level becomes the line where the trade must be closed, not because he lacks conviction, but because he respects the possibility of being wrong. This simple shift in thinking changes everything. Instead of asking, "How much can I make from this trade?" the trader begins asking, "How much am I willing to risk to test this idea?" When risk is defined clearly, decisions become calmer. The trader knows exactly what is at stake before the trade even begins. And that clarity prevents emotional reactions later. Consider what happens when a trader enters a position without a clear risk plan. Price begins moving against him. At first the loss is small, but since there was no predefined exit, the trader begins making decisions in the middle of uncertainty. Should he hold? Should he close? Should he wait a little longer? Each moment becomes a negotiation with fear, but the trader who defined his risk in advance does not face that same confusion. The decision has already been made. If price reaches a certain level, the trade is closed. No debate, no hesitation. The loss remains controlled. Have you ever noticed that experienced traders often speak more about position size and risk management than about specific trade signals? That is not an accident. They know that even the best strategy will produce losing trades. But if the risk on each trade is small, those losses become manageable. Small losses are part of the business. Large losses are usually the result of poor risk control. This is why professionals often appear less excited about individual trades. They are not trying to win every position. They are managing a long series of opportunities over time. One trade fails, another succeeds, a third breaks even. Over many trades, the balance gradually tilts in favor of the disciplined trader. The beginner often believes success comes from predicting the market correctly again and again. The professional understands that survival comes first. Because a trader who protects his capital remains in the game long enough to benefit from the market's larger movements. And those larger movements are where meaningful profits are often found. But they can only be captured by traders who treat capital as something to defend first, rather than something to gamble for the sake of a perfect entry. Most traders enter the market believing their job is to predict what price will do next. They study charts as if the next candle must reveal a clear answer. Up or down, breakout or reversal, win or loss. It feels natural to think that way. After all, every trade begins with an opinion about direction. You buy because you expect price to rise. You sell because you expect it to fall. So it seems reasonable to believe that the trader who predicts the market most accurately should earn the most money. But the market rarely rewards prediction in the way beginners expect. Have you ever made a perfect prediction, entered the trade, and still lost money? Perhaps the price moved briefly in your direction, then reversed before reaching your target. Maybe the timing was slightly off. Maybe volatility pushed you out before the move truly began. It happens more often than traders like to admit. That is because trading is not a game of certainty. It is a game of probabilities. Think of it this way. Imagine flipping a coin that lands heads 60% of the time. If you flip it once, the outcome tells you very little. It might land tails. But if you flip that same coin 100 times, the advantage begins to appear. The edge reveals itself through repetition. The same principle applies to trading. No single trade proves whether a strategy works or fails. One trade is simply an event inside a much larger sequence. Sometimes the market aligns perfectly with your idea. Other times it does not. The trader who thinks in predictions becomes emotionally attached to each outcome. When a trade loses, it feels like proof that the analysis was wrong. Confidence drops. Doubt grows. The trader begins adjusting the strategy or searching for a better signal. But the trader who thinks in probabilities views the situation differently. He understands that even a strong trading edge will produce losing trades. In fact, some of the best strategies lose frequently. What matters is not the outcome of one trade, but the overall balance between risk and reward across many trades. Let me ask you something. When you place a trade, do you expect it to succeed? Or do you accept that it may fail and simply represent one attempt within a larger system? The difference may seem small, but it completely changes the trader's mindset. When prediction dominates thinking, every loss feels personal. The trader feels the need to be right, and that desire often leads to stubborn decisions, holding losing trades too long, moving stop loss orders, refusing to admit that the market is doing something different than expected. But when probability becomes the focus, the trader no longer needs to prove anything on a single trade. He simply follows the plan. If the trade works, good. If it fails, the loss remains controlled and the next opportunity is taken with the same calm approach. Over time, something interesting begins to happen. Emotional pressure decreases, because the trader no longer depends on individual outcomes to feel successful. Instead, he measures success by consistency in following the process. The results appear gradually through repeated execution. This is one of the reasons experienced traders keep detailed records of their trades. They review performance not after one trade, but after many. Patterns appear, strengths become visible, weaknesses reveal themselves. Probability thinking encourages patience as well. If a strategy has a statistical edge, there is no need to force trades constantly. The trader can wait for the situations where that edge appears most clearly. Quality becomes more important than quantity, and when the trader waits for those moments, risk becomes easier to manage. Entries are more deliberate. Stops are placed with clearer logic. Position sizes remain consistent. The entire approach becomes calmer and more structured. But the hardest part of adopting this mindset is accepting uncertainty. The human mind prefers certainty. It wants to know the answer before the event occurs. The market rarely offers that comfort.